Everyone knows buying a home is expensive. Down payment, mortgage, closing costs. You have seen the numbers. You think you know what it costs. You do not. The mortgage payment is the one cost the real estate industry wants you to focus on because it is the one cost that makes the purchase look manageable. The full cost of home ownership is 40 to 60% higher than the mortgage payment alone, and almost none of that gap appears in any disclosure you will receive before you sign. Here is every cost they do not put on the brochure, and exactly why it stays off the brochure. The conventional pitch for home ownership goes like this. Your mortgage payment replaces your rent. You build equity instead of paying someone else's mortgage. Over time, the home appreciates. When you sell, you walk away wealthier than when you started. That is the pitch from every real estate agent, every mortgage lender, and most personal finance content aimed at people in their 20s and 30s. The math works. Under the right conditions, in the right market, over a long enough time horizon, it is true. Life good. Here is what the pitch leaves out entirely. There is a tool called the True Cost of Home Ownership Calculator. It accounts for every cost of owning a home across the full ownership period and compares it to renting and investing the difference. The New York Times has published a version of it. Several academic economists have built versions of it. The math is not complicated. What it consistently shows is that home ownership is a wealth-building tool under specific conditions and a wealth-destroying one under others, and the conditions that determine which outcome you get are almost never discussed by the people selling you the home. The real estate industry generates commissions on purchases, not on the quality of the decision. That asymmetry shapes everything you are told before you buy. Here is every cost that does not appear in the mortgage payment. Start with closing costs. Before you own the home, you pay between 2 and 5% of the purchase price in closing costs. On a $400,000 home, that is $8,000 to $20,000 paid on the day you get the keys before you have made a single mortgage payment. This includes loan origination fees, appraisal fees, title insurance, title search fees, attorney fees in states that require them, prepaid property taxes, prepaid homeowners insurance, and recording fees. Some of these are negotiable. Most buyers do not negotiate them because the closing disclosure arrives 3 days before closing, and the psychological cost of backing out at that point is enormous. The 3-day window is not an accident. Property tax. The national average effective property tax rate is approximately 1.1% of assessed value per year. On a $400,000 home, that is $8,400 per year, or $367 per month, added to your mortgage payment. In high-tax states including New Jersey, Illinois, and Texas, the effective rate can exceed 2%, adding $667 or more per month. Property taxes are not fixed. They reset when the home is reassessed, which in many jurisdictions happens every few years and typically moves upward as neighborhood values rise. Homeowners insurance. The national average is approximately $1,400 per year for a standard policy. In coastal states, flood zones, and fire-prone areas of California and the West, that number is substantially higher. In some Florida counties, homeowners insurance has become effectively unaffordable, with premiums exceeding $10,000 per year on modest homes, as major insurers have exited the state market entirely. Maintenance. This is the cost that surprises buyers most consistently. The standard rule of thumb is 1% of home value per year in maintenance costs. On a $400,000 home, that is $4,000 per year. The actual figure varies widely by home age, condition, and geography, but independent analyses consistently put realistic maintenance costs at 1 to 2% annually. Over a 30-year mortgage, that is $120,000 down to $240,000 in maintenance on a $400,000 purchase, none of which builds equity. A new roof costs $10,000 to $25,000. An HVAC system costs $5,000 to $12,000. A water heater costs $1,000 to $3,000. These are not optional expenses. They happen on their own timeline, not yours. HOA fees. Approximately 25% of US homes are part of a homeowners association. The national average HOA fee is around $300 per month. HOA fees can increase without a cap in most jurisdictions, and special assessments for major repairs can add thousands of dollars in a single year with little notice. HOA fees are not disclosed in the mortgage payment. They appear in the listing, but disappear from the mental accounting of most buyers comparing their monthly costs to rent. Now, here is where it escalates. Added up on a $400,000 home with a 20% down payment and a 30-year mortgage at 7% interest. Monthly mortgage payment, approximately $2,130. Property tax, $367 per month. Homeowners insurance, $117 per month. Maintenance reserve, $333 per month. If in an HOA, $300 per month. Total monthly cost before utilities, $3,247 without HOA, $3,547 with. That is 52 to 66% above the mortgage payment alone. The number your lender qualified you on is not the number you will spend every month. There are several specific hidden cost categories that each operate differently and each go undisclosed in the standard home buying process. Opportunity cost of the down payment. A 20% down payment on a $400,000 home is $80,000. The $80,000 invested in an index fund at an average 7% annual return over 30 years would grow to approximately $609,000. The down payment is not free money deployed into an investment. It is capital removed from liquid investment and converted into a liquid equity in a single asset with high transaction costs on both ends. Most financial discussions of home ownership ignore this cost entirely because it is invisible. No one sends you a bill for opportunity cost. Transaction costs on exit. When you sell, real estate agent commissions have historically run 5 to 6% of the sale price. On a $600,000 sale, that is $30,000 to $36,000 paid to agents on the day you close. The National Association of Realtors Commission Settlement in 2024 introduced new rules requiring buyer-agent compensation to be negotiated separately, but the practical effect on total transaction costs is still being determined. Add transfer taxes, attorney fees, staging costs, and pre-sale repairs, and total exit transaction costs can reach 8 to 10% of sale price. A home needs to appreciate substantially just to break even on the round trip. The interest cost of the mortgage. On a $320,000 mortgage at 7% over 30 years, total interest paid is approximately $448,000. You borrow $320,000 and repay $768,000. The home appreciates, so the equity position improves over time, but the interest cost is real money leaving your household. In the first years of a standard amortizing mortgage, the vast majority of each payment goes to interest, not principal. After 5 years of payments on that loan, your principal balance has dropped by approximately $17,000. The equity building that justifies the purchase takes time that most buyers underestimate. Insurance market instability. This is the newest and most underappreciated hidden cost. In California, Florida, Louisiana, and parts of the Gulf Coast, major insurers, including State Farm, Allstate, and Farmers, have stopped writing new homeowners policies or exited markets entirely. The remaining policies are more expensive and offer less coverage. Homeowners who purchased in these markets 5 years ago with insurable, affordable properties now face annual premiums that have tripled or become unavailable. A home you cannot insure affordably is a home you cannot sell affordably and a home your lender may force you to insure through the insurer of last resort at significantly higher cost. This risk was not on the brochure. The price-to-rent ratio. This is the tool the real estate industry does not advertise. Divide the purchase price of a home by the annual rent of a comparable property. A ratio below 15 generally favors buying. Between 15 and 20, it depends on your time horizon and local market. Above 20, it generally favors renting and investing the difference. Above 25, it strongly favors renting in almost every scenario modeled. In 2024, the national median price-to-rent ratio exceeded 28. In major coastal metros, including San Francisco, Los Angeles, New York, and Seattle, it exceeded 40. At those ratios, renting and investing, the difference mathematically outperforms buying over most 10-year holding periods. This calculation is available to anyone. It is not discussed by agents whose commission depends on the transaction closing. What could possibly go wrong? Here is what happens when buyers anchor on the mortgage payment and ignore the full cost stack. A 2023 study by Bankrate found that 44% of homeowners reported being house poor, meaning their housing costs consumed more of their income than they expected or could comfortably manage. A separate analysis by the National Association of Home Builders found that housing costs for the median home buyer now consume approximately 41% of gross income, well above the 28% threshold that lenders historically used as a guideline for housing affordability. The consequence of being house poor is not just budget tightness, it is the elimination of financial flexibility. The family that stretched to buy the house cannot fund the emergency reserve, cannot replace the car when it fails, cannot contribute adequately to retirement accounts, cannot absorb a medical bill. The home that was supposed to build wealth becomes the mechanism that prevents wealth from being built anywhere else. The insurance market instability consequence is more acute. Homeowners in non-renewable insurance markets who cannot sell their home because buyers cannot obtain affordable insurance are effectively trapped. The asset that was supposed to be liquid in an emergency is illiquid. The equity that was supposed to be accessible is inaccessible. This is not a hypothetical risk. It is the current reality for hundreds of thousands of Florida and California homeowners. Yes, this is real. In 2024, State Farm announced it would not renew approximately 72,000 homeowners insurance policies in California, citing wildfire risk and the cost of reinsurance. Allstate had made a similar announcement in 2023. The California FAIR Plan, the state insurer of last resort, saw its exposure grow to over $300 billion in insured value by mid-2024, a level that insurance regulators described as systemically dangerous. Homeowners who had purchased in good faith in affected zip codes found themselves paying 3 to 5 times their previous premium through the FAIR Plan or unable to obtain coverage at any price. In Florida, the situation preceded California's by several years. Between 2020 and 2023, 12 property insurance companies became insolvent in Florida. Citizens Property Insurance, Florida's insurer of last resort, became the largest insurer in the state. The Florida legislature passed emergency measures in 2022 and 2023, attempting to stabilize the market. As of 2024, average homeowners insurance premiums in Florida were approximately $6,000 per year, more than 3 times the national average. Neither of these outcomes appeared in any standard homebuyer disclosure. The risk was real, documented, and growing for years before it became a crisis. The industry had no structural incentive to communicate it because the commission is earned at closing, not 10 years later when the insurance market collapses. If you are buying a home or considering it, here is how to calculate what it actually costs before you commit. 1. Calculate your total monthly housing cost, not your mortgage payment. Add property tax, homeowners insurance, maintenance reserve at 1% of purchase price annually, and HOA fees if applicable. Divide all annual costs by 12 and add to your mortgage payment. That is your real number. If that number exceeds 30% of your gross monthly income, you are house poor before you move in. 2. Run the price to rent ratio before making an offer. Divide the purchase price by the annual rent of a comparable property in the same area. If the ratio exceeds 20, use the New York Times rent versus buy calculator with your specific numbers before proceeding. Above 25, the burden of proof shifts heavily toward buying needing to be justified on non-financial grounds. 3. Research the insurance market in your target zip code before making an offer. Ask your agent which insurers are writing new policies in that zip code. Call 2 or 3 insurers directly for quotes before you are under contract. If only the state insurer of last resort is available, factor that premium into your total cost calculation and understand what you are buying into. 4. Negotiate closing costs. Sellers can contribute to buyer closing costs as part of the purchase agreement. In a buyer's market, this is routine. In any market, it is worth asking. A seller credit of 2% on a $400,000 purchase is $8,000 you do not pay out of pocket on day one. 5. Understand your amortization schedule before you close. Ask your lender for a full amortization table showing principal and interest for every payment over the life of the loan. Look at how much principal you will have paid after 5, 10, and 15 years. If you are likely to sell before year 10, the equity you are building through payments is smaller than you think. Transaction costs on exit can easily consume it. 6. Model the opportunity cost of your down payment. Take your down payment amount and calculate what it would grow to over your expected ownership period at 7% annual return. That number is the floor your home appreciation needs to clear for ownership to beat renting and investing. In many markets and time horizons, it does. In others, it does not. The math is available to you. Use it. This is not financial advice. Please do not sue us. If this reached someone who's about to sign a purchase agreement based on a mortgage payment number and nothing else, share it. The industry is not going to run these numbers for you. The channel grows when the right people find it at the right time.